Hello and welcome to the Stock Planner channel. We're an education channel, sharing ideas and sharing our successes. No financial advisors here. Each of us do our own due diligence and take our own risks and win. Tonight, we're going to talk about reducing trading risk using options. Let's get started. I use bull put spreads and bear call spreads primarily for my trading. I'm a swing trader, trying to capture the major peaks and valleys, and these spreads allow me to obtain a credit and reduce my risk. Let me show you my style of trading. I'm a swing trader, and I try to capture these tops and bottoms to make some serious bank. This is on the Bank of America on the daily time frame. I'm using a free package called TradingView, and it has many different indicators out there. This is the zigzag indicator. And currently it's pointing up, but I use the zigzag indicator is a perfect indicator. It looks to the future though, and so you have to use other indicators to kind of judge where these tops and bottoms are. I like the MACD, the zero lag MACD, when it's way below the zero line, when the stochastic RSI has been below the 20 and come back around, and when the RSI is below the 30 and come back around. And if they all occur at the same time, that's the time to go long. This would have been a nice long trade. More currently, we have a MACD, zero lag MACD, way above the zero line. The stochastic has went around, and so has the RSI. And we had a little dip, but now we got that little pop there. You have to ask yourself, is this stock going up there, or is it coming back to the 50%? I think it's going back to the 50% over the next 2 months. So, this is your support and resistance line. That's your all-time high as well. And here's your support. Resistance is at 45. If it hits resistance, it goes back down. It's a common occurrence. Or it could thrust on its way through. I think we're going to have a lot of bouncing around just like this here. Anyway, that's the strategy I use. Those are the indicators I use. And I have an algorithm that each day gives me those kind of signals that I take a long or a short trade. So if I think this is resistance or support over 45, I would place a trade using a bear call spread in the hopes that Bank of America will stay below that line for the next 2 months. And how do I do that? Bank of America, I keep saying card, but it's Bank of America, but I do have their card as well. And I'm using a tool called OptionStrat, and I'm looking for a bear call spread. It puts this out there for me, and what I usually like to do is put the short strike right here, and you can see that short strike, and the long strike. And I try to have it about 500, try to make plays at around $500. This expires on the 24th, so I'm selling a strike for some premium here, and buying one for protection. It's going to cost me $500 to put the trade on, and a net credit of $118 and a loss of $382. That's pretty significant. So if I win, I win $118. If I lose, I lose $382. And if I have a 50% system, that's not good. Let's see if I can do a little better. Increase my odds, reduce my risk. Moving this to October 8th brings the net credit up, but still not enough. This is 47 days out, 350, 150. Let's see if we can do one better by going to November. 325 to 175. So what I did was I experimented a little bit and brought the strikes in. And it's now a dollar wide spread on October, expires on October 15th. And its max loss is 51 and my credit is 49. That's as close to a 1-to-1 that I can get. That's perfect. And I usually like to trade in $500 blocks, so I can do 5 of these. Bear call spread, you sell a strike and buy a strike for protection. Normally if you widen it out, you can get a better credit loss ratio, or profit ratio. In this case, shortening them did just that. Now on my back testing system, it's tested at 8% peg. There it is. And my back tested system is that more than half of the trades that I place pegged and closed out within 18 days. So let's just take this and divide it into half there. And a good risk management profile would be to risk less than you make. In other words, you always make more than you're risking. So this is 8% profit. That's your peg. Excuse me, this is not profit. This is your stop loss. That's your peg. That's your max loss. This is your profit. And this is 8%. So if it stays below, if the price stays below 42.49, we can win 8% profit and around 3% stop loss. And backtesting has shown that around 5 of the 10 trades, for every 10 trades, about 5 of them close out early, which means that it either pegged for a stop loss or it pegged for profit. And you can take profit around between 35 and 40. So it's 37 is an average. And you close 5 of them out. The other ones, if you get to here, 1 month, you don't want to be here. You want to close those right out. And you're going to be somewhere in this range here. And you have the hopes that your losing trades will come back down below and be a max winner. My back-tested system is 75%. So I'm going to lose 3 and win 7. And hopefully the 3 I lose will be somewhere up here in the 35 bracket or in this area here, 35, 40, but no more than that. So you're minimizing risk by taking a 2-month out. You're putting your net credit to be almost be 1 for 1. And in case of I want to do a little bigger transaction, so I'll do 5 of these, collecting $250, and hopefully we'll be able to keep around 200 of that, which gives me about for one trade, keeping $200 would be around approximately $100 a month. And I just have to do 3 to get $300. If you're trying to get 3% a month, you have to do 3 or 4 or 5 or 6 of these. It's not that hard to do. The important thing is to try to get this to be as close as you can to 1 to 1. You want to close out most of them here. You want to take the 8% wins and losses whenever you have them early. And you want to have what's remaining on the plate to be in this area here. And you want to hope for the best. Of course, some of these are going to peg down here too over time. And some of them are going to reverse the other way. If you have a system that gives you 75% win rate, this could be very profitable. So let me end this up. A bear call spread and a bull put spread, which is the opposite. Let's go long. Bear call spread is go short. It's a fine risk. The risk is you win 50 and lose 50. You place these at the money, currently trading at 42, and as long as this stays lower than 42.49 in the next 2 months, you win the max, which is $49. Or you could lose the max, $50. 50-50. And if you have a 75% system, that means you 77 wins and 3 loses. That means you win more than you lose. And so you have 3 losses and 7 winners. That leaves 4 left over, 4 max, and that gives you $200. $200. If you do nothing, but I don't do nothing. I manage the trade halfway through, see where we're at, see if I like what I got to close. I manage it each day to see if my 8% targets have been reached, and we get close to the end. I don't want to lose everything, so if there's all hope, I close it out. If there's still hope and there's money, no money, and there's money left in, I'll just hold it. If you were going to go and buy the stock for a small account, you would do so with about $1,000 to $1,200. That same small account will buy 10 of these contracts. So you can do a lot more with options. I think you can reduce the risk, because if you buy the stock, there's no ending. The market tanks. The worst you're going to lose is $50. I like it, especially in these hard times. Please let me know in the comments below what you think of this trade. Do your own due diligence. Don't take yourself too seriously. Please like and subscribe to the video. We need your help. Happy trading. Catch you on the flip.